Hey, welcome back. In this lecture, we're going to talk about Chapter 14. And what we're going to do here is cover the end process of a DCF analysis. So what we've already done so far is cover all the basics, at least, all the practical knowledge you need to go from forecasting a firm's cash flows, analyzing their financial statements, predicting and reorganizing the future financial statements, and then calculating free cash flow, taking the present value of the free cash flows, adding them all together. The sum of the present values of the free cash flows is called the operating value of the firm. The end of a free cash flow, of a discounted cash flow model, however, is something called the enterprise value of the firm. And the enterprise value of the firm is the sum of the operating cash flows, or the operating value, and the non-operating value. And then we're going to talk about how to move from enterprise value down to something that we're often interested in as investors or as evaluators, and that's the equity value, the portion of the firm that belongs to the firm's equity holders. And so we'll talk about the most common things that come into play there and how we move from one to the other. Okay, so we'll do this in 3 stages. First, we'll talk about enterprise value. We'll talk about the most common types of non-operating assets, how we value those non-operating assets. And then once we've valued them, we add that to the value of operations, operating value, in order to get our estimate of enterprise value, which is the total complete value of the firm and everything that the firm has. Then, because we're often interested in what the equity value of the firm is, we're often interested in what portion of the firm is owned by its equity holders. We'll talk about what we need to adjust from enterprise value to come down to equity value. And basically it means we need to subtract anything that the firm owes to someone else. Right? So debt equivalents, which are things that look like debt but aren't called debt. Any kind of hybrid securities, we won't do a little bit of talking about that because I'm not sure who has and hasn't had an options or derivatives class. So we'll do a little bit of talking about it, but just at a very high level. And then finally, we'll calculate the value per share, and that's pretty simple. Divide the equity value by the number of shares outstanding. Okay? And then this is essentially it for the technical part of a DCF. Once we have calculated equity value, we are finished with our DCF model, and we can take a little break. We can breathe a sigh of relief because the next step, of course, is to make sure one last time, go through it and analyze our results. We want to make sure that we didn't make any big glaring errors, that we didn't make any assumptions that sort of destroy the model or mechanically make the model untractable. And that'll be the last lecture for the class. Just a brief discussion of the most common mistakes people make. How do we catch them? How do we think about those kinds of mistakes? And then we'll be done. Right? So we got 2 more lectures for the class. They're both relatively short, and then that's it. So we'll start by talking about the process from here. So just in a quick little graphic, right? Enterprise value is the sum of the present value of the firm's operations, right? And this is what we've been doing all semester, just this first column here. We've calculated the present value of the free cash flows, and we've calculated the present value of the continuing value. Add those 2 together, that's the present value of the operating part of the firm. But the firm can have other non-operating assets. And remember back when we did our walk through a short DCF for UPS, we looked at a few non-operating assets and we removed them. Things like excess cash, any other kinds of weird illiquid investments, or maybe equity holdings or unconsolidated subsidiaries. And so we'll talk about the most common kinds of non-operating assets and how we value them. Remember, we have to value them because we're going to add that value to the value of the firm's operations to get enterprise value. From enterprise value, we're often interested in what portion of enterprise value belongs to the equity holders, because oftentimes we're doing one of these analyses because we want to buy some of the firm's equity and maybe take a big stake. So I want to know what proportion of the firm belongs to the equity holders. And to do that, we subtract any non-equity claims on the firm. So anything that the firm owes to anyone else, we've got to remove that. So the most common stuff is debt, but anything that looks like debt but isn't, anything that we might owe to our employees like pensions or compensation in the form of options, any kind of minority interest, so somebody has a stake in our firm and so they have a claim in our firm, anything like that needs to be removed for enterprise value. What's left, or what remains or what's left is equity value, right? Equity is the residual claimant. So they have whatever isn't already promised to anybody else. And then to determine equity price, we divide the equity value by the number of shares that are outstanding. Now let's see that this little formula here laid out in a simple example. Okay? So here's the first part. Right? This is the value of the operations plus the value of any of the non-operating assets. And there are lots and lots of, basically anything could be a non-operating asset. It is any asset that the firm has that doesn't directly have to do with what the firm does. Right? And so a non-operating asset for one firm might be an operating asset for another firm. Right here in this example, we have excess cash and then excess real estate. But if I'm a real estate investment trust, all of my operations are real estate. If I'm an apartment rental company, all of my operating assets are real estate. I don't have any excess real estate. That's not a non-operating asset for me. Right? So it's going to be different for every firm. We just have to recognize what the firm actually does and try to understand from their financial statements and any footnotes exactly what assets are operating versus non-operating. And we may not always be able to tell that. Right? We've got non-consolidated subsidiaries here. This is and we've talked about these before, but this is a stake that the firm has in another firm. I own a piece of another firm, but I don't own enough to have full financial control of the firm. And that's what it means by non-consolidated. This is a piece of a firm that I own, but because I don't have financial control, I do not consolidate their financials in with my own. If I fully and completely own a subsidiary company, another company, then they don't file separate financial statements. We consolidate their information in with our own. Non-consolidated subsidiaries is a small enough stake that I don't. All I would do is report some kind of equity holding or a non-consolidated holding there, and then I would report their income, the investment income on my income statement, and that would be the dividends that they shared with me or something like that. Okay, so I would report that on the balance sheet, but and the income statement. But remember, when we do our DCF analysis, we remove anything from NOPLAT and invested capital that isn't operating. So I would have taken off investment income from the income statement when I calculate NOPLAT, and I would have not included in my reorganization to calculate invested capital any kind of equity investments. So this is where I value them. Okay, I don't ignore any of that. I just value it separately. A financial subsidiary, it might be a wholly owned subsidiary. It probably is a wholly owned subsidiary. It's most typically for firms that sell their product on credit, like intentionally, like a car company. Most cars aren't bought outright, they're leased. And so, for instance, Toyota, Ford, GM, they all have huge financial subsidiaries that are basically just like banks that only do one thing. They make loans for cars, and only the firm's cars, right? Those financials might be consolidated. The problem is that valuing a financial firm is significantly different than valuing an operating firm. And so we actually are going to have to unconsolidate or do our best to unconsolidate the financial statement for a financial subsidiary and value that as if it was a standalone company all on its own. Tax loss carryforwards, we talked about that. That is losses that the firm has made. They get a tax credit on those losses. You can book that as an account in the income statement and the balance sheet. It's an asset because you can use those tax loss carryforwards to reduce your future tax balance. We'll have to value that and any potentially ongoing tax loss carryforwards that we might be earning. And then discontinued operations. This is things like we've been shutting down a plant, so I still own the plant and the land and the machinery, but in the process of shutting down the plant, I'll be selling these assets off. So it's not a part of my operations because I'm not in the business of selling decommissioned plants, but it is a valuable asset that eventually I'll be able to sell. And so I'm going to list it here until it's not there anymore. So now you can see that if I add all of those things to my DCF value of operations, I get my total enterprise value. And this is the sum total of everything the firm owns. Right? Now the hardest part about this, about valuing and adding the non-operating assets, is in the valuation. Right? Remember that the value of anything is the present value of its future cash flows. So I have to estimate that for each of these assets here, and sometimes that's not an easy thing to do. Sometimes it'll be easy. So there's sort of two groups here. The first group is things that are considered marketable by accounting rules and our IRS law. They must be listed and what's called marked to market. And that means that every accounting period, whatever that is, if it's a quarter or a year, we must re-estimate the current market value of these things and then list the value of those assets at the current market value. So for cash, that's easy, it's just cash. But if the firm has some short-term bonds as its marketable securities, maybe it has some equity holdings, I need to go find the current market price of those and then recalculate the value of those assets based on the current market price. Right? Some things are going to be illiquid, so they're not considered marketable, and those are the harder things to value. Because if I have a market price and they're a marketable security, I mark to market, I can just use the book value because they've already done the hard work of calculating the market value for me. If it's illiquid, I'm going to have to value them individually and separately. And so we'll sort of walk through each of these and talk about how you do that.